Hi there, I'm Mark Sebastian, founder of OptionPit.com, and this is the Option Pit webinar of the month, trading options for trading the VIX for profit. I do want to remind everybody that my book is for sale, Trading Options for Edge. Somebody asked, who's my target audience? If you are listening to this webinar, then you will like this book. I spent a lot of time on it, and I worked real hard. So with that, let's get down to the presentation. Trading the VIX, trading VIX and VIX ETPs. I'd like to remind everybody that this is for educational purposes only. None of this should be considered investment advice. Options do have risk, and that you should consult a financial professional. This is not meant to be advice in any way, shape, or form. So, let me talk about myself. If you don't know me, my name is Mark Sebastian. I was a floor trader for about 10 years. Everybody that works with me was a floor trader at Option Pit. My number two was a floor trader for about 17 years. My director of operations, my other number two, was a floor trader for about 17 years. And then we've got another writer that works with us that is also traded on the floor for almost a decade. So we combined have about over 50 years of expertise. So what is Option Pit? We are an education and consulting firm. On the educational side, we have all sorts of programs that can teach you how to trade and think like a professional trader. I'm going to kind of preview some of what we do here tonight. And then we also work with hedge funds, money managers, asset managers, financial advisors, teach them how and help them implement, test, and stress test options in their portfolio. So it's a lot of fun what we do. We really enjoy it. So today's is gonna be kind of like a crescendo. We're gonna start out with relatively simple. Then by the end, I'm gonna get into some pretty deep trading strategies. So if it seems a little mundane at the beginning, it will get better as we move along, and then I will take questions. So what is volatility? Volatility is a measure of movement of an underlying instrument over a period of time, regardless of direction. All right. The higher the volatility, the higher the movement and or expected movement of the underlying. All right. When we discuss volatility, no matter how long to expiration, the number is an annualized number. So what does that mean? Well, I'll show you what annualized means. So let me pull up an SPX options. Well, tomorrow's Friday, so there's all sorts of options expiring. So let me pull up Apple options. All right, so these are the January 5th Apple options. They expire tomorrow. And what I want you to notice is that the January 175 calls have an implied volatility of 18.99. Now, what does that mean? That means between now and expiration, which is tomorrow night, the market is expecting Apple to move almost a touch under 19% on an annualized basis. All right, so that means it'll move 19% annually for one day. Does that make sense? All right, and then the options that expire next week are trading at 15.05. So the market is expecting them to move at a touch over 15% on an annualized basis between now and Friday. So between now and Friday, Apple will move 15% annually. It's an important concept. A lot of people don't understand. So there are three main types of vols that I'm going to talk about. Historical volatility is how much an underlying has moved in the past over a set number of days. All right. Realized volatility is how much an underlying is moving right now. And then there's a concept called implied volatility, and that's how much the market is expecting the underlying to move over a set future time period. All right. right, so let me just briefly look at these. I'll show you a picture of Apple here. And we'll talk. I want to quickly look at realized volatility for and historical for Apple. So this blue line is how much Apple has moved on an annualized basis over the last 20 days. All right. So over the last 20 days, all right. So over the last 20 days, Apple has moved at about a 16% annualized rate. All right. And that's historical volatility. Now, what is realized volatility? Well, let's look at a chart. Realized volatility is kind of what Apple is doing right now. So what is happening today? Those are trading days. This question was calendar days or trading days? Calendar days. Realized volatility is divided by trading days. Implied is calendar usually. So realized volatility is kind of what's happening right now. So Apple is moving a lot or it's not. So the best way I have to kind of look at realized volatility is I'll look at 10-day HV. So what's happened over the last 10 days. And what I'll do is I'll look at those and compare, okay, has volatility been higher or lower than it was? And the answer is currently it's been higher than it was. So, you know, I'll use it for that. So that's what realized and historical volatility look like. So let's talk about implied. So RV is a type of HV. That's correct. So what makes trading volatility different than trading a stock? And the answer is, and I trade volatility. That's it. The answer is, over the long term, I know where implied volatility will go. I don't know where a stock price will go. There's a mean reverting characteristic to implied volatility. Let me show you. This is a chart of Apple. You guys might have heard of it. All right. You can see this is from like through November. Does that look like there's any real mean? Now, you'll have your chart people. You'll have your chart people say that, oh, there absolutely is a mean. I mean, you can see it here or in this. You can see it in you know, in this thing or that. And you know, my answer is there really is not. There is not really a lot of mean reversion. There may be near-term trend lines, but there's not a long-term mean. Right. So then I want you to look at, this is the VIX of Apple options. Now, that gray line is the 200-day moving average. Does that look like it has a mean to it? There's a 1 year. Does that look like it has a mean to it? The red line is the 50-day moving average. So you can see the red line will move around, but it's basically moving around the blue line. The blue line is a great representation of implied volatility. So your mean is based on your time frame. No, I mean, yes, it's hard to have a mean over a 3-day period, but if you look over several years, there is mean reversion to anything. So again, a stock price can go anywhere and stay there, and volatility can go anywhere, right? VIX can get to 100. It can get to below 9. But over time, it will revert. All right. Yeah, Rick, so the 200 is closer to being the mean of all. Yeah, it is. It's a good way to look at things in some of those. So understanding this will help you with buy and sell decisions. So one thing to think about is that most traders think of mean reversion as an instantaneous thing. It is not. And I'm going to change this to Jan 2018. All right. Vols can stay low for a very long time. You know, see the 2.5-year period between 2012 and 2014. See July 2016 to Jan 2018. But it can also get at sky high. See August of 2015 when VIX was really elevated for about 4 months, 5 months, from August through February. And then think about October where it was high for about 3 weeks. Or in 2008 when it was high for about a year. It's important not to have a recency bias. A recency bias is the VIX is 9, so it has to stay there. It does not. All right? It does not. It could go to 100. It could go to 200 theoretically. It could go to anything. I mean, it's unbelievable. So don't have a recency bias. Always take things in context for they on 2 levels. 1, they can stay low or high longer than you think. And 2, just because we're low doesn't mean it can't go to 100. A VIX of 30, a VIX of 100 means the IV of the 30-day out SPX is 100, correct, basically. All right, the VIX. Here's what the VIX is. The VIX is the CBOE Volatility Index, formerly the CBOE Volatility Index. The purpose of the index is to gauge the buying and selling of options in the S&P 500. It gauges cost of insurance. The idea is that when there's more buying over selling, generally, the market is trying to buy protection. And when there is more selling than buying, the market is not out seeking protection. So think of it this way. VIX up, cost of insurance up, cost of options up. VIX down, cost of options down. Similar to the S&P 500, the index is not actually traded. You guys are aware that there's no way to actually buy the S&P 500. You can't go call your broker and say, buy me the SPX. It's an index. There are index funds. There are futures. All right. It will, you can do a basket. NDX you can't buy or sell either. NDX is another index. There's no way to buy. Yeah, there's options on the index, right? But there's no way to just straight up buy the index. Yes, there's all sorts of ways to get almost there, get 99% there with SPX. Right? If you do the long synthetic, you're going to pay the bid-ask spread. So you will still be a little bit underneath. Everything trails the S&P for the most part. All right. Now, what's different is there's no way to even recreate VIX on a straight basis. There's nothing that trades that can get to a 99.9 correlation with VIX like the futures can or SPY can. There's nothing. All right. The VIX is essentially an estimate of implied volatility on the S&P 500 options that has a constant duration of 30 days. That means the VIX has 30 days to expire right now. Tomorrow it'll have 30 days to expire. Monday, 30 days to expire. All right. So the problem with trying to do, like with the S&P, how often does the basket, how much do you really need to rebalance a basket of the S&P 500? You know, you're trading a share or two here and there. With the VIX, it is using so many options. It calculates any option with a bid. It is using so many options. The cost of trying to create that basket would completely make managing and constantly allocating would completely make what you've got in VIX irrelevant. So the VIX always has 30 days to expire. That's important. The VIX is quoted as a price, but it's really a percent. Volatility, despite not being spoken as a percent, is always a percent. So a VIX of 10 is actually 10% annualized volatility. Can anybody else think of anything that is a percent that we maybe don't describe as a percent? It is recalculated every 15 seconds. That is correct, Mike. Delta, yes. How about batting average? How about grade point average? Taxes. There you have it. So it's at the batting average is 3 digits, correct? But it's a percentage. The VIX is 4 digits. When the VIX is 10.23, it's actually 0.1023. Where that, John? I'll talk about that in a minute. So this is the VIX over the last 3 years. And what I want you to notice is, you know, this is a weekly VIX. So this is the weekly ranges. And what I want you to notice is that, yeah, there's some periods of time. Take a look between like August of 2015 all the way through kind of March. VIX was pretty elevated. There's a little period of it being down in December, but it's pretty elevated that whole time. You know, we had another period where it jumped around in 2016, right in here. But for the most part, the last 3 years have been calm. The VIX negatively correlates with the SPX. When SPX is up, VIX is down. When SPX is down, VIX is up. This generally makes sense because volatility does tend to increase when the market sells off. All right? There's also the nature of similar movement against the lower number. All right? You guys want to know one of the reasons why the VIX is now 10? Well, all right, I'll tell you. All right. 6 years ago, what was the value of the S&P 500? About 1,000. All right, so if the S&P moved 20 points, or like today, the S&P moved 10. The S&P rallied 10 points. Was that a big deal? Yeah, it was a 1% move. That's not small. It's not tiny, right? A 1% move, a 10-point move in the S&P 6 years ago was 10 points. That 10-point move meant the VIX should be around 16. A 1% daily move means the VIX should be around 16 or 17. All right, so now the S&P is 2,700. We moved $10 today. That's 0.33%. 0.35. So it's way less. So you need a lot more movement. We would need, in order to get the VIX at 16, we would consistently need movement of like 27 points. When you see a 27-point move in the S&P, do you think things are busy? A 27-point move in the S&P now is the exact same as a 1-point move a 10-point move in the S&P 6 years ago. You can make a lot of money trading futures. All right, now there's some other things involved in the calculation, but I'm not going to get too deep. All right, so there was a question. Does the S&P, does the VIX put a heavy concentration on at-the-money options? It is far more influenced. So it is the most influenced by at-the-money options. It is slightly, and then puts slightly out-influenced calls. And that's caused by skew. So let's talk about VIX futures. They're one of the most successful products released in the last 20 years, at least domestically. There's been nothing this good released domestically. They're traded out 8 months plus the weekly futures. Each month trades independently, not like the structure of SPX, which is based solely on carrying costs, right? So the thing to think about is, so the active S&P future right now is March, correct? Right, it's ESH. All right, so how closely will the March future correlate to the March 2019 future? Yeah, about 99%. About 99%. All right. Now, the VIX futures do not correlate nearly as well. They don't correlate nearly as well. Think about the VIX future as if I'm holding a rope and a jump rope and I wave in one hand and I wave it around. The stuff at the end is going to move a lot more than the stuff near my arm, right? That is how VIX futures work. VIX futures are a lot like if you think about the S&P is like kind of holding a bar and moving it up and down, and VIX is more like holding a chain. They're linked, but they're not. They don't move necessarily exactly the same. So only the VIX spot is linked to S&P IV. Yes. The back month futures are tied to long-dated. The back month futures are tied to long-term expectations of VIX. Like a kite. I like that, Danny. All right. So even if you buy a deep in the money VIX future, you're just basically buying a VIX future, not VIX. Yeah, that's not true, Danny. So June VIX futures have nothing to do with July options in the S&P. Correct. Well, they do, but they don't. Right? So let's look at this. That's a good question. So let me show you. Let's pull up SPX. This will take a minute. It's at night. Yeah, it takes a while to load. We can watch cat videos while it loads. Yeah, sure. Or how about you guys buy my book? Everybody go and buy the book while this loads. That doesn't own it already. That means you, Danny. Oh, good work. What kind of beer are you drinking? Miller Lite. Oh, good. Can't wait to see you. You know, interesting thing about Miller Lite. There are only two markets where Miller Lite outsells Bud and Bud Light. And those two markets are Milwaukee and Chicago. This is live vol. I don't know why this is taking so long. We'll come back. That was a good question. We'll come back to that. Remind me at the end. I can, but I don't want to. You know, the richest guy trader that I ever knew only drank Miller Genuine Draft. We'd be at this fancy Christmas party, and everybody's drinking wine, and he'd have an MGD. So this is a picture. If you have never been to VIX Central, check out VIX Central. It's awesome. This is VIX Futures from November. Remember, VIX was 985? And that is what things look like. Now, this is a Contango. And a Contango is what VIX futures are in about 85% of the time. That's when spot is cheaper than the front month future, is cheaper than the second future, is cheaper than the third future. I would love that. Thank you, Ephraim. Now, this is what we call backwardation. This is from, you can see, November of 2008. And what you've got is spot is higher than the front future, which is higher than the next future, which is higher than the 60-day future. This happens about 10-15% of the time, at most. All right? So let's talk about VIX Options. VIX Options, and the one thing I will say, how many of you have have gone to some webinar and the guy has a trade where he's named a trade? You know, oh, it's the oopsie doopsie trade. It's the lazy eye trade. It's the limp trade. Anybody ever heard somebody go on air and say, "Oh, I've got this trade and I call it this or I call it that"? It's the wacko condor. It's the woozy butterfly. All right. Ha, the weekly wheel. Yes. That's actually an adjustment. So here's what I'll tell you. if I had a really good trade, if I had a really great trade, all right, and I've got some good ones, all right, if I had a really, really great trade, what do you think I'd do? You think I would trade it, or you think I would name it and talk about it? If I had something that was destined to make money, what do you think I would be doing? No, I'm not. Yeah. So I run a hedge fund. All right. I will talk to you about how I think, kind of the things I think about. And sometimes after I'm done putting on my trade, I'll tell my students what I did. But do you think I ever go on and teach exactly what I'm doing? Here's a hint. No. Yeah, if you pay attention to our blogs, you can figure things out. Like I said, we'll talk about what we're doing and what we're thinking, but we never are, one, we don't have any named trades. So my point is, if you're following somebody that has a named trade, they're going to generally work really well when VIX futures setup looks like this. It does not, Trevor. The book's awesome. All right. Why hold back? Because if I'm making money doing something, the more people I tell about it. All right. Correct. I'll teach you how I think. I won't tell you what I do. Does that make sense? So now, if you're doing the lazy eye trader, if you're doing the lazy eye butterfly condor combo, and you're looking at this type of VIX futures market, guess what? None of those rules are going to work. Everything you know, all those guys, this is the market that creates the blow up for all those guys that have these named trades. This is when they all blow up. All right. So let's talk about VIX options. They're the most successful option product introduced in the last 20 years. Again, they trade out 8 months. Each month trades independently. Now, here's the key with VIX options. The underlying for a VIX option is the future, not the cash index. So if you want to know what the underlying for the Jan option is, it's like 10.5, not 9.12. Typically used as hedges. They are huge. All right. There are, people are like, oh, there's so many people shorting VIX. Well, how about the guy that puts up 1 million contracts every month going long? Or the guy that buys about 500,000 contracts a month? All right, so now VIX options and futures are European exercise. That means there's no early exercise on them. They're cash settled. I like you, Rick. And as a man who definitely knows how to fish, that comes in even better. All right. They have a unique settlement procedure. No, they're not. Someone's saying they're losing their shirts. Well, the reason why they're hedging is because they're long something else that's probably doing great. The so-called 50 cent has a massive credit portfolio. I don't know what the quote-unquote VIX elephant has. All right, VIX option. All right, at 30 days to expiration, they typically move at about 0.5 to 0.6 of VIX. So at 30 days to expire, the Jan future, if the VIX was up $1, the Jan future probably moved 40 to 60 cents. Oh, hi, Howie. Now, as time passes, beta to VIX increases. So the day before expiration, a VIX future will correlate to VIX at about 90%, 95 maybe. That was the funniest thing I've ever seen, Howie. Thank you. So let's talk about VIX activity. All right. VIX options have about 12 million open interest. All right. Well, I put out an idea every week, George, and we had a guy that said he traded them that made something like 85% or something crazy. I'm usually pretty good. I actually put out my trade idea of the year on Tuesday. Spoiler alert, it was a Disney leap call. Check out the VIX activity. They have more daily volume than most stocks have open interest. VIX options are ridiculously active, super tight, and awesome. I love them. So let's talk about using the options. So recall, the VIX options at the money strike is not the cash level, but the future. So every month has its own at the money strike. And that at the money strike is moving all the time. So look at this. All right. So when I took this picture, January was 1330. You know where January is now? $10.5. So what's interesting is if you look, the at the money option for November is the 11.5s. The at the money options for December is maybe the 12s or 12.5s, and the at the money options for January is 13.5. 14 for February. March, 1460. All right, so let's talk about trading short. All right, if you want to trade short VIX, the best way to do it is long puts or put spreads. All right, so trading short, the long put. All right, the long put simulates short a future, only has capped losses. That's why I like options. It will have some time premium. Premium is less for out-of-the-money spreads. And it's useful for what I call the convergence trade in periods of Contango. That's betting that the future will grind toward the cash. So let's talk about the convergence trade. So take a look at September. If I buy a at-the-money put in September, what is my at-the-money option? This is easy, guys. All you have to do is look at a picture. 14.5. Right. 14.5. If I buy a 14.5 put, how deeply in the money will it be at expiration with the VIX at 1140? It'll be $3 in the money. So take a look at this. This is January. These were the options. All right. Take a look. So VIX is 985. Should I be able to buy the January 12th put for $1? Well, what's 985 plus $1? What's 985 plus 1? Again, easy math, people. 1085. What is 12 minus 1085? $1.15. Correct. So if I buy this put for $1 and VIX stays at 985, how much money would I make? I'd make $1.15. No, I'd make $1.15. I'd make $1.15. Should I be able to buy $1 of an option that at expiration automatically makes $1.15 if the underlying sits? If I buy a 12 put, no. If I buy the 12 put, I'm betting VIX is going to stay here, and I'd make $1.15 just holding the put. Nothing has to happen. Normally, when you buy puts, you want the underlying to drop, right? Doesn't depend on skew. Right? Here, I don't even care if the underlying drops. If the underlying sits, I make money. The underlying could rally 50 cents and I'd make money. If the underlying rallies $1, I still make 15 cents. All right, so that is the convergence trade. That is the best. Coming up with a smart convergence trade, if you're going to trade VIX options, is the best trade. All right, now let's talk about trading long. There are reasons to trade long. It's a hedge. With the, if I held a huge portfolio of long stocks, if I don't have a hedge with the VIX at 9 and the Jan future 10.5 and March below 12 or March below 13, if I don't have a hedge on, I'm an idiot. So when using VIX options to trade a higher, so I would put on a long call spread with the VIX here, if I against a really long portfolio, or to hedge a big short premium trade. Yeah, Rick, not quite the same. All right. So because of the nature of skew, VIX has a crazy skew. Buying a call that's at the money and selling it out of the money call can be super favorable. All right. Because VIX vertical skews, call spreads are way better than straight calls. I almost never buy calls, but I will definitely buy a call spread. So let me show you this. This is from December. Obviously, this didn't end up being worth anything. But look at this. If I held $1 million portfolio of long S&P, I could buy the VIX 12.5 20 call spread for less than $1. How's that for payout? It's not bad, right? All right, we're back. So it's really cheap to hedge. How much would for $1 million portfolio, how much would you hedge with one call? Not very much by one call spread. But you could buy a lot and hedge pretty well. Yeah, it's really nice. It's a nice trade. Does the trick. So the point is, this is a great, great hedge. All right. So, any questions on VIX or VIX options before I start? I start on the ETNs. Yes, hence the huge volume. They're hedging huge portfolios. You know, the guy that's long 500,000 VIX calls. Do you ever sell call spreads? I have. That works, but with the crazy spikes we've had, it can be a problem as well. You know, there are. I'm not going to get into crazy detail. What I will say about, someone was asking about, would you trade VIX into expiration? Almost never. I try not to. And I'll tell you a story. I had a big, huge VIX 1x2 on, where I was long the 10.5 put in December. I was long the 10.5 puts, short the 10s, 1x2 for a 2-cent credit. And the day before expiration, I sold out of it at an average price of about 4-cent credit. I made a nickel. And then the next day, VIX settled at 875. I had 1,000 by 2,000 on. I would have lost about $75,000 trading it if I hadn't covered. So I always cover. Would I really do that on a 20-to-1 ratio? No. These are just, I had something else on against this. So ignore the position. These were totally unrelated. I kind of ignore unusual trades in VIX because they're 99% of the time. The question was, how do you use unusual trades? 99% of the time they're against something else, so it's impossible to guess what the position is. And yes, I do time my entry. All right, so let's talk about the ETNs. So as VIX futures have become more and more actively traded, each of the ETNs has a stated purpose. However, due to term structure, they sometimes have some unintended consequences. You guys know who King Sisyphus was? If you don't, read. If you do, then what I will say is, Sisyphus is famous for having pointless or inimitable tasks. That's kind of what VXX and the major, he'd push a rock up and it would fall every day. Greek. Thus Zeus. If it was Roman mythology, it would be Jupiter, not Zeus. So, yeah. VXX. VXX is the iPath S&P 500 short-term futures ETN. It attempts to replicate being long a VIX future with a constant duration of 30 days. Makes sense, right? The VIX has a constant duration of 30 days. Why wouldn't you want a future with a constant duration of 30 days? Right? Makes total sense. Except, it tries to allow a trader to follow near-dated forward volatility. The fund does this by constantly rolling out of the front month and into the back. Now, it's a lot more complex than this, all right? But in simple form, explanation, would you ever want to run a business that bought something for $16.10 and sold it at $15.50? No, what would happen? Yeah. If you bought a share of VXX on the day it listed, what would your profit or loss be? On one share, $102,000. $102,000. With how few shares you own now. UVXY is even worse. So VXX is rolling itself to zero. It should not be held for more than a few hours if futures are in Contango. The VXX is great, though, for volatility day trading. It can be a hedge against a falling volatility portfolio. If you've got a portfolio that's long vol, which you can, if you're a straddle buyer or a gamma trader, it can be a hedge against falling volatility. But it's poor against rising unless it's very well timed. Well times? Well times. This is what a chart of VXX looks like from 2008. Right, no, I get it. Correct. It's an artifact of, yes. So someone's pointing out that technically it's an artifact of backdating. Correct. Right. But you can see how bad it is. Different product, same result. VXZ. All right. UVXY is double long. It's levered. It's optionable too, which I love. Jack, I don't know why I don't trade SVXY. I should. TVIX is double long. And XVZ, maybe the best of the bunch, but it doesn't trade much. I use UVXY. I almost exclusively use UVXY. Unless the vols are off. When the vols should have a relative comparison, and they can be off. So let's talk about a long-term approach. This is what I call the IRA VXX trade. When VIX is in a normal contango, a strategy that is highly effective and passive is holding long-term VXX puts. So what I might do is buy puts in VXX that are at the money, expiring in 12 to 24 months. I unwind when VXX reverse splits. I unwind when the VIX begins to flatten. All right. I never hold these ETNs when the VIX is backward. Why do I unwind when it reverse splits? Because the liquidity completely dries up in the options. You can't trade anymore. All right. Well, what about the alternative holding XIV long term? What I like about owning puts is what? Limited risk. XIV is great, but I have seen XIV lose 90% of its value in about 3 weeks. VXX options are not at 1256, I don't believe. And an XIV can go to 0. All right? Yeah. Someone said I checked the option train earlier, and somebody is doing this. SPXY, I think, is just single XIV. All right, unwind. So now the short-term VXX. Here's my trade that I like in VXX a lot. One can set up trades with edge using VXX that may have many expirations. Here's what I use. And this is one that I will do in my hedge fund. I've changed this up, but it still works. I've come up with something a little better, which is why I'm talking about this. But I did use this in my hedge fund. I buy VXX at the money options with about 2 weeks to expire. Every time the options increase by 50%, I roll down to a new at the money. If inside a week, I roll down and out, going out to the next contract. So I'll sell that and then go out to a contract with 2 weeks. If the trader applies the same dollars constantly, it will, the captured dollars actually creates a hedge by taking money off the table. If one wants to go bigger, remember I talked about VIX hedges? If you want to do a big VXX short, you can do long puts in SPY or SPX, or use VIX call spreads. So this is a trade from that I looked at in October. I was long the 35 puts, and this is a period where VIX moved around, and then nicely a week later they were up a little bit, even though VXX was really not down that much. Down about $1.30, but these had like a day or two to expire. I can show you a more recent version of that. Did my SPX options finally populate? They did. All right. So somebody asked, does June correlate to the June future? Let's take a look. June is 11:30. And then I'll show you a trade in VXX. Currently, the June future is 1440. So it's higher, just like the it's higher, just like VIX, but it's not the same. Oh yeah, you're right. But you get it. Not exactly the same. So let's look at VXX, and here was a trade that I actually did do. This was more on volatility. I thought the Jan 12 weekly was too cheap. So I bought the 27 puts in Jan, for about 70 cents. They dropped. I sold these out. And I sold these out. So I paid 70. I sold the Jan 27s at 120. And I paid 50 cents for twice the amount of 26 puts. I'll be out of these by LiveVol is not my proprietary software, but my students have special pricing. It's actually an execution platform. All right. So I did this 1 by 2. So now what I've done is I've collected 20 cents and I'm long twice the amount of 26 puts for the cost of one of the 26 puts. So that was what I did. Right now, if I was going to throw on any trade, I like the 26.5 puts for 76. But yes, this is recorded. But truly, as I look around at kind of how the market is pricing itself, I think regular January is probably too cheap. 26 puts for 80 cents. I'll take them. So the inverses are kind of the opposite of, I don't know. All right, the inverse ETNs are theoretically going to infinity, but have a daily tracking issue that causes them to underperform. All right. So you have XIV, which is the reverse of VXX, ZIV, which is the reverse of VXZ. I close TLT. And then SVXY is similar to XIV, but optionable. There's XIV. But take a look. Look at how much it can lose in a very short period of time. So I could see a scenario where XIV drops from 130 to about 50 in about 3 days. So there's the summary. Now let me talk about my offer. So right now, Andrew has been teaching a course called Easy VIX. All right? And it's 5 courses. He has done, sure, I'll show the summary page. Inverse ETNs are not perfect. VXX and the ETNs are going to 0. The inverses are not. Bear and bull plays have different structures. IV and VIX are correlated. Each has their own underlying, and VIX contracts have unique characteristics. So Easy VIX. All right. We are offering this course. We offer this course at $97. It's going to be $197 when it goes in my store. All right. Now, we are 4 courses through. We're doing the 5th one on Tuesday. I will give you the 4 recordings plus the 5th one plus 1 month of access to my chat room for $27. $27. That's cheaper than my book, and you get a month of listening to me. Go to optionpit.com/easy and use code CANDLE70. And you get to listen to me every day. So here's what you're going to get. You're going to get the 5 Easy VIX courses. You're going to get 1 month of OP Live. www.optionpit.com/easy. That easy. Oh, it's next Thursday. You're right. You'll have lifetime access to the 5 courses. You get 1 month of OP Live. So what is OP Live? Well, I'm in the chat room, other than these last 2 weeks, where I've been taking the day off, for about an hour. And what I do is I look at what's going on and I come up with my 3 best ideas. And they're pretty good. My goal is to pay for the entire $97 a month subscription every day. All right? And you'll see me, I do a lot of the trades. You get a daily chat, and I'm in, it's open all day. And I'm in there usually in the morning. But the nice thing is when I'm done, you can cancel the subscription if you buy this. Don't worry. So every day I do a 3 to 5 minute video with my 3 ideas, and it's called the Chat Wrap. You'll get that video sent to you via email. All right? You'll get a preview of Andrew Mark's new VIX newsletter. Andrew is working on has been putting out a VIX newsletter. We're going to start charging for it in a couple of weeks, but you're going to get a preview of it. All right? You can ask me a question. Yes, that's why you got to use code CANDLE70. If you use CANDLE70, it'll take the $70 off. All right. You'll get live interaction with me, with Keith, with Andrew, with Leisha, with the other traders. There are good traders in that room. And like I said, it's $27. What are you going to buy? I mean, I'm going to refill my SodaStream for $27. Right? Yesterday, I bought, I spent way more than that at Target buying my kid underwear. You want to know what was embarrassing? I wasn't sure what size underwear he wore. He's 8. So I tell him, I go, come here, turn around. And I pull the back of his underwear down so I can see the size, right? Well, guess what? There was no size. Why do you think there was no size when I pulled the little tab down to see the size? What do you think? No, he had his. I wish he was wearing. I wish he wasn't. Yep, Mike got it right. They were on backwards. They're out, and this is a kid that this is the same kid that scored 99th percentile for math. So, plus you get this type of interaction on a daily basis. The way that we chat with each other, I mean, this is I have a relationship with the guys in my room. And so does Andrew. And you're going to get a lot of great education. So, yeah, I do too. No. Can we get a deal on the book too? If you live domestically, we'll tell you what, Mauricio, if you buy a second month of our subscription service, I'll send you a book. How about that? How much will the Vol newsletter cost to OP subscribers? I think what we're going to do is it's going to be an extra $23. Can I share a trade idea? I'll tell you why I can't share a trade idea from yesterday today. We go borderline dark for 2 weeks a year, and this has been it. But I will tell you what I did do, and everybody saw me do this. In SPX, oh, I can't do SPX, can I? Everybody saw me do this in VIX, if the options ever show up. In VIX, I bought the 10.5, 9.5 put spread for 45 cents. All right. Yeah, and on the letter on its own, I think we're going to charge 97 for it. It worked for me. Let me see. Candle 70. Apply. Yeah, it works. Joe, if you can't get it to work, shoot me an email and I'll just rebate the $70 back. Can you explain why you don't take VIX trades into expiration? I thought I did. You never know where that print's going to be. In the case of the regular December, VIX settled $1.25 lower than it had closed the previous day. That's a 12% move. Can I do this tomorrow morning and still participate in tomorrow's room? Sure, Becca. But why wait? They're not that bad. Man up, Danny. Isn't it a good rule of thumb to not ride any options into expiration? Generally speaking, yes. But especially with VIX and SPX, where there's a print. Have I really been talking for an hour and 15 minutes? It is $27 after the discount. Use candle 70. So you can see 97 minus 70, 27. Yeah, it is. Fifth talk is next Thursday. Go to optionpit.com/easy. It's a hidden page. Woo! You're welcome, Danny. All right, any other questions? Regulators. How much is trading room with the subscription? 97 after the first month. All right, everybody have a great day. The room will be really active starting Monday again. All right, great. Have a great night, guys. Don't have a space between the 70 for the discount. Yes. All right. Good night, everybody. I'll have this posted to the blog tonight. Yes, it's online. Good night.